Hi, this is Leah Jagielka, and I have Alan from BMT Tax Depreciation. Normally, every year we would do our investors' night, but due to COVID-19, we're making it a little bit more online. So, welcome, Alan. How are you?
Very well, thank you.
Good, good. So normally we would go through different people at our investors night, and BMT Tax Depreciation is one of our guests that we normally have brochures and things of. So we're just going to have a quick chat to Alan in regards to what exactly is a tax depreciation schedule, and he will guide us through everything. So the floor is yours, Alan.
Okay, well, thanks very much for having me, Leah, and for potentially having me in your lounge rooms or kitchens or wherever you're watching from. So I've been with BMT for nearly 10 years. So what I'm going to do is basically go through a bit of a slideshow, explain a little bit about what depreciation is, why it's beneficial for you. We've got a few case studies in there and a few numbers, but nothing too extreme, so it's not going to be like sitting in accounting class or anything like that. We'll cover a few of the frequently asked questions as well, and then I guess a bit of an open floor question Q&A type thing at the end. So we're playing around with technology here, so let's see if we can get this to work. I'm just going to share the screen. Okay. So can we see the slides there on your end, Leah?
Yeah, definitely.
Excellent, excellent. Okay, so we'll go back. So property depreciation is where the ATO allows you to claim the wear and tear on your investment property. So they do concede that over the course of time when you're renting a property out, items in the property are going to suffer wear and tear, as is the building. So they let you claim a percentage of the construction cost and a percentage of the value of the fixtures and fittings as a loss every year on your tax return. So very similar to how your accountant might claim a laptop or a phone or something that you buy for work purposes. Those are tools that help you generate income. Obviously, an investment property is a vehicle that helps you generate income. So the ATO is going to let you claim some wear and tear on those items, whether it's real or envisaged. So before we get too far down the road, I'll just quickly touch on BMT. So BMT are a quantity surveying firm, so we're not accountants. Quantity surveyors typically work in the building industry in a number of areas. So they might work in pre-construction. So if someone wants to build something, you know, you're building a big high-rise unit development or something in the city, the bank typically won't give the builder $30 million and trust them to manage those funds. So they'll go to a quantity, so they'll tell them to go to a quantity surveyor, cost up the project, determine exactly what it will cost to build, and at what stages the money should be released as well. So that's our kind of traditional bread and butter work that we started with about 20 years ago, but BMT specialise in post-construction these days. So that's what we do day in, day out. What we're dealing with is a property that you've purchased, or you might have a build contract if it's a house and land package. But basically, the build contract or the purchase price, the accountant can't really work with that. They need somebody to break things up and say what everything's worth so they can claim the depreciation properly. So that's why the ATO specifically states that accountants and real estate agents and property valuers can't do these reports. It's got to be someone that works in the building industry like BMT. So I'll just quickly touch on the components depreciation's made up of. There's basically two main components, and one is the building and one is the fixtures and fittings within the property. So what that looks like very quickly, if you've got the structural elements of the build valued at $260,000, so it might have been a build contract of 280 or something like that, or 290. 260,000 is the structural elements. So that's the bricks and mortar of the house, paving, driveways, retaining walls, but also kitchen cabinetry and elements of the bathroom. Now, anything either built after 1987 or any renovations that are done after 1987 qualify for this claim. The ATO lets you claim it over a 40-year period. So if you've got a house that's built in 2010 and $260,000 is put on the ticket, you're going to be able to claim $6,500 a year every year until the year 2050. So 40 years of that. Never goes up or down. It's just a constant amount that you can claim. So an example of the other component, plant and equipment items, is the accounting term, but I guess for us at home, it's fixtures and fittings. We're talking about the kitchen appliances, light fittings, smoke alarms, air conditioners, carpet, blinds, things of that nature. So they're claimed a bit more aggressively. So something like a dishwasher, you're going to be able to claim at least 25% of its written down value back in the first year that you put the item in your investment property. So in essence, a couple of points to touch on there. One, obviously you can imagine how all those fixtures and fittings are going to add up pretty quickly and get you a lot of money. And two, it's an expensive dishwasher. I think we'd all agree. So that's probably an interesting point as to what we do as quantity surveyors. When we break up a build contract, when we look at the assets, we don't just look at the value of the dishwasher, but we also look at the associated costs surrounding that asset. And that can be things like the architectural fees for designing the kitchen, for the place for the dishwasher to go. That can be the fee for the plumber to install the dishwasher. It can be the fee for the electrician to put the power point in for the dishwasher to plug into. And it can also be other preliminary costs with the builder themselves. So when they're deciding what brand of asset they're going to put in your place, we can take some of those initial consultation fees as well at the very early stages of the build and kind of make an allowance for that in the asset. So I guess that's one way that BMT really maximize a claim for you. So sometimes, even if you've done a renovation and you have a bunch of invoices, the accountant will still tell you to go to a quantity surveyor to get them to break the renovation up in a tax effective way for you. So if we combine that knowledge about depreciation and put it into an actual case study, if you will, we'll just quickly look at that now. So say you've bought a unit for $530,000. You're getting $450 a week rent for it. Means your annual income is a bit under $24,000. Then you've got the expenses. And as you can see, the expenses are more than the income. So it's a negatively geared property. So expenses are going to be things like the interest on your loan, strata fees, property management fees, landlord insurance, and general repairs and maintenance as well. So basically in this example, it's costing the investor around $8,400 a year to hold on to the property before tax, or $160 a week. So on the left-hand side, it's not all bad news. Basically, you'll go along to your accountant with that $8,389 loss, and they'll pop those figures in your tax return. We've put this person on a 37% tax rate, meaning that they're getting 37 cents in the dollar back on any deductions that they claim. So they're getting 37% of that $8,389 back in their pocket, assuming they normally get a tax return. So after the accountant lodges the return with those expenses, it goes from costing them $160 a week to $102 a week. So they've kind of recouped about $50 a week by claiming those expenses. On the right-hand side, you'll see that we've got depreciation in there as well. Now, that's a pretty realistic number based on average amount that we might find in a new unit build. Obviously, there are outliers. So if you've got, say, a 3-bedroom unit in a complex, it's not uncommon for us to see deductions closer to $19,000 or $20,000 in the first year of claim. So this is, I guess, a tame example, but basically depreciation is a loss that you can claim, much the same as the interest on your loan or anything else. But the only difference is it's what accountants refer to as a cash-free deduction, which means that you don't have to spend money to claim it. So if you want to claim the interest on your loan, obviously you're paying money to the bank every month over the course of the year, and then you've got the total interest I've paid. I'm going to claim that as a deduction. Depreciation's just there if someone's done this report for you and they've given your accountant the figure. So I guess crudely speaking, it's a bit more complicated than that, doing the tax return, I'm sure, but basically the accountant's going to take that $13,750 of depreciation and they're going to claim that along with your other expenses. And as you can see, now you're getting 37% of $22,000 back in your pocket, as opposed to 37% of the $8,000 on the left-hand side. So you can see it makes a big difference. Next to claiming the interest on your loan, depreciation's the next biggest thing that you can claim, generally speaking. So it's definitely something to look into and ask the question in that respect. So it does apply to older properties as well. So I guess I won't walk you through the exact same cash flow example in the same amount of detail, but very quickly, another negatively geared example, we can see that the expenses outweigh the income, not as much as the previous example because the loan amount might be a bit less. They don't have strata fees like you do in a unit complex, but even so. Now, the average claim that we find with an older property, so that could be a 90s build or early 2000s build, or even an old property that's had a substantial renovation, it's typically somewhere between $5,000 to $7,000 is the average that we see out of something like that. So it's still worthwhile, and we'll touch a little bit later, I guess after the presentation's done. I'm sure there's some questions and we can touch on, how do we know if it's worthwhile or not? So we'll definitely get into that a little bit down the road. Very quickly, we BMT do specialize in commercial properties. So I actually, these days, I guess because I've been here for a while, I do work in our commercial specialist team. So you may not have commercial properties managed potentially, but you could own them in a self-managed super fund if you're a small or medium business. We pretty much do anything commercial wise. Personally, I've worked on everything from a small warehouse to this hemisphere's largest solar farm down in Port Augusta. So I actually flew down there and worked on a $430 million US build. So we pretty much do everything in that respect. I don't expect there's any solar farm owners in the room, but pretty much if that's relevant to you, by all means get in touch and we can chat about that further. So we do get a few frequently asked questions when people call in. So I'll try and cover those quickly. First one, can my accountant do this? Kind of touched earlier that the ATO doesn't allow accountants to estimate construction costs. Certainly if you had just one item like I got some carpet installed and I've got an invoice with the labor and everything, the accountant can certainly do that. If you buy a property or if you have a build contract, that's sort of where we need to get involved. Or if there's a complex renovation or something, that's probably the bit where the accountant's going to say, go and chat to BMT and they'll help you out. Is the property too old? It's never too old to ask the question. We always give an estimate of likely deductions that you're going to see before, like when we give you the quote. And further to that, even if we do the report, if we don't find at least double our fee in deductions in the first year that you use the report, then we cancel the report and we don't charge you. But you'd be surprised, sometimes people think the property's old, but they're not aware that the previous owner might have done an extension, or they might have put a pool in, or they put a big deck on it. There could be a number of things that previous owners have done that you're able to claim on. Common question we get relating to fixtures and fittings with secondhand properties. Why can't I claim on them if I've bought a secondhand property? The government changed some laws with depreciation in 2017. So basically, they've limited what you can claim on a secondhand property in terms of the fixtures and fittings. So I showed you those two examples before, where you had the $6,500 a year for the 40 years from the build date. You're still able to claim that. They haven't changed that. What they have changed is your ability to claim on, the carpet that's in the property that's 20 years old. So previously we could put a value on some of those older assets in the property, but they kind of restricted that back in 2017. So if you add assets in yourself, you can claim on those, of course. So if you're signing a management agreement and the property manager says, if you put some new kitchen appliances in and replace the ratty old carpet and put some new blinds in, then we can probably get a better rent price for you there. Anything you put in yourself, you can claim on. It's just, the 30-year-old chef stove that's sitting in the kitchen that you can't claim on anymore. Average deduction that we find with new and second-hand residential properties. So with new properties, the average is a bit over $9,000 in the first year of claim. So that kind of encompasses, your small 1-bedroom townhouse or 2-bedroom townhouse, all the way up to your 3 or 4-bedroom units. So units are kind of the outlier because you're able to claim on common areas and things like that. So if you've got a complex that's got a pool and a gym and a sauna and stuff like that, you're able to claim a percentage of all of those things as well as your unit. So that's sort of where you see the big outliers in the high teens. But generally speaking, for a house, it's around $9,000. For a second-hand property, as I touched on before, probably somewhere between, anywhere from $4,000 to $7,000 is what we see with second-hand stuff. So still definitely worth doing. Can I claim on renovations or works that I've done or a previous owner's done? Yes and yes. So basically, anything you add to the property you can claim on. Anything the previous owner's done, you can also claim on. So we would estimate the construction costs associated with putting the pool in, or if the previous owner's put an extension on or something like that. And you're definitely entitled to claim on that stuff. Can you backdate the report? So yes, the report will always begin from your settlement date. So if this is the first time you're hearing about depreciation, when we do the report, we'll be able to put all the numbers in there so that your accountant has everything they need. The ATO does allow you to go back and amend previous tax returns. So the numbers will be there and your accountant will be able to tell you, look, there's enough deductions that are there for us to sort of go back and go through that process to amend those returns. Final question is, obviously we do the report for you, but what happens in 3 or 4 years' time if you remove an asset from the property? So yeah, very common situation. You might get a phone call from your property manager and they'll say, look, the dishwasher has broken. It's 3 or 4 years old. We need to put a new one in there. There will still be a residual value left on that dishwasher. So it won't be completely depreciated at that point, potentially. So when you remove an asset from the property, you can actually write the residual value off immediately in the year that you remove it, as long as you've got us in there prior to that and we've established a value for that dishwasher. So if you do a renovation or if you do replace assets after you get a report, definitely give us a call and we can work with your accountant to make sure that you don't leave any money on the table. So there's a few tools and resources that you have at your disposal, totally free of charge. They're all free to use. So obviously if you hop on the website, you can access a lot of this. Likewise on Android or Apple devices, if you search for BMT, you'll see a number of calculators and things that will pop up. And that goes anything from a basic depreciation calculator where you could put some details in about your property and it will spit out an average based on, we've done over 600,000 schedules in the last 20 years. So we've got a lot of data there. If you tell us it's a 1995 build and it's 4 bedrooms, it'll spit out a bit of a summary for you to give you an idea. That's if you don't want to give us a call and talk to us about it, of course. We've also got a few things that are kind of new, which is My BMT and PropCalc. So My BMT, basically a live depreciation schedule. So when you organise for us to do a report for you, there'll be an online portal you can log into and actually manage your depreciation schedule. So if you misplace it, you can download it again. If you change things with the property, you can, as you can see in the example there, you can tell us, I've changed these things, and we can update the report for you. Now, PropCalc is pretty cool, and you can use this in a couple of different ways. So one way you can use it, if you're looking at buying a new investment property, you can search for the address, pop in what type of property it is, how old it is. You can pop in your purchase details, so the loan amount, what your deposit is, are you doing LMI or not? You can pop in what weekly rent you're going to get, what the property management fees are, general estimate on what kind of maintenance is going to be happening. And, Leah can probably give you guidance there as to, what you should budget for maintenance wise. And basically what this thing will do is it will spit out a summary that tells you, is the property negatively geared or positively geared? How much is it going to cost you a week to hold onto the property after you do your tax return every year? And obviously you can save properties. So if you're in the market and you're looking at a few examples, you can compare them side by side and look at the numbers. So it's a very cool tool. And again, it's all free for you to use as well. The other thing that you'll get with PropCalc, and also if you do a report with us, you get free access to research and insights, either for a property that you already own or a property you're looking at. So research and insights, it's going to tell you if someone's building, a 12 townhouse development next door to you, and you know that they're not going to have any parking and you're going to have cars all over the street, it could be a time to move out and rent best or something. You also get free property valuations. So it's a desktop valuation similar to what a mortgage broker would do for you. And you'll get notifications if the value of your property goes up, based on recent sales in the area. So all free stuff for you to play around with. Process-wise, if you give us a call, we're going to discuss what your property is likely to get in depreciation and make sure it's worthwhile before we go too far down the road. We'd organise an inspection with Leah or the tenants directly, so you don't have to organise that. The inspection and every component of what we do is handled by our own people, so we don't outsource anything. That's really important. If you get audited or something like that, you don't want it to become a finger pointing exercise as, oh, is it our fault or is it the guy that inspected it? We back our reports 100%. As I said before, we've done over 600,000 depreciation schedules and we've never failed an audit with the ATO. So of course, with some properties, they might ask a question about it. We handle all that for you if something goes wrong. Likewise, if you don't know information, like I touched on before, that the previous owner may have done an extension or something, if we do searches with the council to find that out, which we will, some councils will charge a fee for pulling records. We wear that cost. So if there is any extra cost there with that, we'll wear that. It's the cost of doing business. There is no extra charge for you. But yeah, that's that kind of brings us to the end of the formal presentation. So I'll just stop sharing the screen and Leah can put me in the hot seat and put me in the firing line for questions now, I guess.
Yeah, definitely putting you on the spot now.
Okay.
So obviously we're meeting over Zoom due to COVID-19. So what has BMT put in place to protect yourselves, protect the tenants, protect, the properties from any spread of anything with COVID-19? What are you guys doing differently now?
Look, we are still operating. We are still doing inspections and everything. But basically, we've obviously had to listen to the relevant medical advice, federal and state advice about safety procedures for operating in the current times. So, that's not limited to, obviously none of our team have been overseas anytime recently. We're using appropriate PPE. So obviously gloves, masks, hand sanitizer, and it's probably just a few extra measures. So, in the past, if we were doing an inspection, the tenants would be like, do you need us? No, I'll just sit on the couch while you do your thing. Whereas now it's a little bit strange because we have to say to the tenant, well, can you go and open all the doors for us so that we're not touching things? So there's a few different things we've had to implement like that to minimize risk for us and also for the tenants or whoever's meeting us at the property. But that's okay. That's what you have to do. You have to adapt and just, that this could be the new norm for some time now. But yeah, basically it's just, we're still operating, but the inspections might take a little bit longer than they used to take because of those extra things. And, the tenants might have extra questions and stuff as well, which we're always happy to have a chat to the tenant and put them at ease so that, they're not concerned about anything.
Do you normally get, so anytime we're having a sales appraisal or anything done for a property, do you normally get tenants concerned that, oh my God, there's a tax depreciation, there's someone coming through, they're going to sell the property and my house is going? Do you normally get that as well?
Yeah, it's happened. Look, as I said, I've been here for nearly 10 years. So sometimes I'll, have to go out on the road if I'm doing a conference and I'll help the local guys out with some site inspections. And it happens all the time. I've had situations where they've let me in and I'm doing the inspection and, they're sitting outside, the tenants are sitting outside and, I can hear them saying, oh, geez, they must be selling because they think it's a property valuation. So, I must be selling, we're going to have to start looking for somewhere. And, you know, I'm like, look, sorry to, and all of our guys have had this and girls, and it's sort of like, look, sorry to eavesdrop, but this is a report for their tax. You can't use the report unless you want to keep the property and keep renting it out. The report's useless unless, you know, you're renting the property out. So, you know, to our knowledge, they're not selling the property. So, you know, sometimes it's that. Sometimes they ask you directly as well. Oh, you know, are they going to sell the property or something? You know, obviously, if we were told that they were, we wouldn't necessarily say, oh yeah, like it's like there is a confidentiality thing there, of course, but it's sort of, no, not to my knowledge, and sort of explain what the report's for and how it's used in a tax return, and you know that you can't use it any other way. So if the report's $770 on average, it's unlikely that they're spending nearly $800 on a report for no reason.
Just to sell the property in another couple of months anyway.
Yeah, exactly.
So, sorry, I keep looking down because I did take notes when you were talking. So, obviously you did say that if an investor asks for a report and you find out that they can't claim as much as what you thought, I think you said it was double the fee?
Yeah.
So how would an investor, so say an investor comes to me and says, I want a tax depreciation schedule done on my property. Mm-hmm. We would just go about, set that up. And how would you instruct the landlord that it's not really worth their time? Would that be at the report stage or?
Yeah, so I mean, sometimes it is at that initial discussion where we ask certain questions that'll, like I touched on very briefly, the building or the renovations being done after 1987. Typically we'd ask, you know, it's not a scary thing to inquire with us. There's probably 4 questions we're going to ask you. And that is, how old is the property? When did you buy it? When did you start renting it out? And what renovations have you done, if any? Or probably 5. Did the previous owner do any that you're aware of as well? Now, if we get some answers to those questions and it seems like it's not going to be worthwhile, then we'll just say, look, based on what you've told me, there won't be anything there. So that's one way. Another thing that can happen is that someone might tell us, yeah, the property was built in 1998. Okay, it's definitely worthwhile, let's do it. And then we get out there and it's actually 1978 or something. And there's potentially not much there. So I've had situations where the client thought it was one age and it wasn't, but they've done $20,000 or $30,000 of works. They've updated the bathrooms and the kitchen or something. Even if that happens, and we've done all the work and done the inspection, we'll call the client and say, look, based on our first discussion, we thought that this would be worthwhile. The property's actually built in this year, so we're not doubling our fee anymore. We give you the option to say, well, look, I don't want to worry about it. And there's no charge. We don't charge for the site inspection if we've already gone out there. It's just a guarantee that we offer. That said, that particular client, I said, based on your renovations, there is going to be about $300 or $400 a year there for you. So that's where it comes down to your financial situation. So if you're getting a tax return every year and we say there's $300 a year there for you, that means that it's going to get you $100 a year probably in your pocket, somewhere thereabouts, maybe a bit less. So, you know, that's probably not going to be much of a drop in the water. So some people would say, look, I don't want to worry about it. The other side of the coin is you might get a tax bill every year. And then if I say we can reduce your tax bill by $400 a year, then some people will see the value in that and say, I still want to proceed with it. So if we have that where, you know, we're not doubling our fee, but there is something there. It could be $400 or $500 a year. We usually address that case by case and try to come to an agreement where both of us are happy with it. And that might be we reduce the fee for the report a little bit to say, well, we're not doubling our fee, so we don't feel good about that. But you still want to claim those deductions that we've found. So, let's find somewhere where we're happy. So that's probably the two most common scenarios where, something's not worthwhile for someone or not meeting that guarantee, I should say.
Is there an easy way for an owner to find out the age of the property? So, I mean, us as agents, we can log on to Price Finder and things like that. And we can normally see, there was a large jump from when it was just land and it was sold to, hey, now it was sold with a house. I know some houses you can open the meter box and it's written in there. Is there any other little tips or tricks that landlords can find out the age of their property?
Well, yeah, I was going to say that they could ask you. Look, they can obviously contact the council. So as part of our due diligence, when we do a report, we do have to, even though you can't claim land, the ATO want us to put in the land value, just so we're definitely looking at the right property sort of thing. So yeah, we normally contact council to find out build dates. Sometimes if the council doesn't have records, we can look at when was the first time that power or water was connected to the site. That's usually another bit of a giveaway of, well, we can't find the build year, but the first time that water was connected was whatever year it was. And it's like, well, that's a pretty strong indicator that was the year it was built. So yeah, I mean, outside of contacting the council or getting a Price Finder or RP data account, I would say just, speak to Leah or speak to the professionals in your circle and see if they can help and kind of leverage off them a little bit.
Yeah.
Or call us and we'll look into it for you.
Yeah. Okay. So is there a good time? I assume that May, start of June, you guys would be run off your feet from a lot of landlords that, get I need to go get my tax depreciation schedule done for the accountant. When would be a good time for them to get a tax depreciation schedule, and how long does one last for?
Sure. So I guess first part of the question, a lot of people will organise the report. So they'll call us and say, oh, look, we're settling in a couple of weeks, and they like to get it organised at the start regardless. So they've got all their kind of operating costs or establishment costs, do it all together, and then we don't have to worry about it again, because we see people forget about it all the time. But it's really whatever suits you and your strategy. So some people will call us around May, because obviously the fee for the report is tax deductible. So if it's our standard fee of $770, then you incur that expense closer to the end of the financial year, so that you're not sitting on the expense for 10 or 11 months. And you can then claim that fee in your tax return that year, and get some of that back a bit quicker as well. So I guess it's always a good time to think about it. Or, that's what we'd like. But yeah, I guess particularly at the moment, if you haven't already looked into it, it's probably good. We've got feedback that, touch wood, it doesn't happen to too many people, but, with the COVID stuff, some tenants are asking for rent reductions and things like that. So obviously depreciation could be a way to enhance the cash flow a little bit if you have lost some somewhere else.
That's actually a good point, to try and balance it out a little bit there. So yeah, obviously if the tenants are paying a little bit less in their rent, us agents are taking a little bit less in percentage as well. So you get a little bit cheaper there, but in the long term, to try and get a depreciation schedule and claim back on tax, that's going to give you a lot more than what we can on discounted rates.
Yeah, and I guess the other question you had was how long does the report last for? So it's a lifetime schedule. So that the ATO lets you claim on the building for up to 40 years from the build date. So our reports last for the 40 years. So the only time that isn't the case is if you've made changes to the property and you need it updated, in which case we can update the report, and then it's, business as usual from there.
Yeah. So for most investors out there, $770 would do them for 40 years.
Yeah. So, I mean, whether you hold the property for 40 years or not, depends on your strategy, I guess. But yeah, certainly, it's generally a one-off thing.
Yeah. Perfect. I think that's all the questions that I have. Oh, actually, no, there is one more. So with investment properties, we do have occasionally some that are fully furnished. So when you're doing your depreciation, I know it comes with fixtures and fittings, which, carpet and curtains and things like that.
Mm-hmm.
Do you ever get fully furnished properties, and do you ever get asked to do a depreciation schedule on furniture?
Yeah. So we can definitely include furniture in a depreciation schedule. If an inventory is provided, which usually there is one, because I guess Leah wants to know if the tenants left and nicked the coffee table or something. If an inventory is provided, we don't charge to include the furniture. If an inventory isn't provided, then we just charge an extra $55 on top of the $770 because it'll take a bit of extra time for us on site to walk around with a checklist and go, there's that many 2-seater lounges, that many 3-seaters, there's that many dining chairs, cutlery, crockery, pots and pans, linen, all that stuff. You can claim all of that.
Yeah.
So yeah, very common question, and a lot of people don't think that. Oh yeah, I should mention the furniture, and we see it sometimes where people live in the property and they rent a few rooms out or something, which is a common thing. And it's like, well, what do the tenants use? Do they use your TV? Do they use your barbecue? Do they use your cutlery? And it's like, oh yeah. I was like, well, we can include all of that. So a lot of people, it's sort of, they think, oh, surely you can't claim that. We're doing one for someone at the moment. He's got, PlayStation 4 and different game consoles and stuff. It's like the tenants use them, we can include them. Obviously, the accountant would just work out a percentage of personal use and not claim 100% of the figure in our report.
Yeah. But once Airbnb is right back up and running, it would definitely be something for people to look at if they've had their property in Airbnb in the past.
Yeah, absolutely. So that's probably one of the most, I'd say in the last couple of years, that's probably the most common scenario for a furnished property. If we're not looking at, you see them a lot where there's a lot of government jobs. So, Canberra's really common for it, where they do have furnished rentals because someone might get relocated there or something. But yeah, the other thing would be Airbnb. So many people either doing half of their house or a granny flat out the back or even a full house. That's where we're seeing the majority of people that want furniture included in the reports.
We'll see where I'm in Sale, and we've got the East RAF base, East Sale RAF base right here. So we've got a few furnished properties that are promoted to the RAFies and the SO gas plant and things like that. So yeah, it's good to know. So our landlords can get their tax depreciation schedules on their fully furnished properties too.
Yes, for sure.
But I think that's it. Thank you so much for that, Alan.
That's okay. I'm happy to be involved, and thanks everyone for listening. Hopefully you made it through. Depreciation can be a little bit scary topic at times, so people go, oh God, I feel like I'm back at uni or something. So hopefully I made it interesting and you guys got something out of it.
Easy done. And if anyone has any questions, they can contact Alan at BMT Direct. If you need his details, I can send them through to you. So just let me know.
Perfect.
Lovely. Thanks for that, Alan.
No problem at all. Thanks, Leah.